Five, four, three, two, one. Thunderbirds are go. Hey, welcome back to the Funcast, everybody. Appreciate you joining. We're going to dive right into it because this is a hot topic that's very topical, and we have quite an important guest here. So, how we got to this guy, I have no idea. I know how we got into it. We basically twisted his arm through a friend. But anyway, we have Tuck Hardie, who's a managing partner in the financial restructuring group at Houlihan Lokey, probably the premier restructuring group on the street, as the kids say. So welcome to the Funcast and my condolences, Tuck.
Oh, happy to be here. And we like to think that we have the premier restructuring franchise on the planet.
Oh, great. I meant the
Street.
street as like the whole street, like not
Yeah.
just one particular street, but the whole street.
Our group is on lots of streets. We're on every continent except Antarctica now.
That's amazing. Yeah.
Yeah.
So let's do this. Let's do a quick bio. How did a nice guy like you get into a nasty business like this? One, is it a nasty business really? It serves a necessary purpose in the world. And so how did you get into it? And kind of what do you do every day? Like, are you an investment banker? Are you a lender? Like, what does your day feel like, knowing that we've got people who are in banking and private equity and advisory work and running companies that listen to this pretty regularly? So yeah, quick
Sure.
bio and what you do.
So I got into the financial restructuring business actually because I was a client. One of my former employers, Marvel, before it was owned by Disney,
So Marvel as in like Marvel Comics.
Stan Lee and Spider-Man were my boss. We went through a bankruptcy process when the company was owned by Ron Perlman, and Houlihan Lokey was one of the advisors in that process. And after we got out of bankruptcy, we had a change in ownership and a new balance sheet. After we got through with that process, I hung around for a while and then had a disagreement with the board over the long-term direction of the company, and left and called up the folks at Houlihan that I had worked with during our own bankruptcy and said, hey, I was a pretty good client. You were a good advisor. I need a job. And so 23 years later, I'm still here. And in what I do, because I do most of my work on behalf of financial sponsors, is help sponsors figure out, how to deal with their creditors in a myriad of circumstances. From on the easy end of the spectrum, they have a covenant issue, or they need some flexibility to buy something or bring in some new capital to buy something, to the more complicated end of the spectrum, which is kind of what we're doing a lot of right now, which is I can't afford my balance sheet. Rates have spiked. Money has essentially been free for the last 13, 14 years, depending on how you count it. And it's not free now, and it's not going to be free for a long time, in my perspective. And I try not to just sell my own book, but look at things more objectively. And there were a lot of balance sheets that were put in place, pre-COVID, when money was relatively inexpensive. And, everybody kind of got through COVID through a series of amend and pretends, or amend and extends, as we call them. Nobody took on equity capital during COVID. They all took on more leverage. So now you have a bunch of businesses that were probably properly levered pre-COVID. They took on more debt to survive the decline in cash flow from the fact that all we all bought was hand sanitizer and toilet paper. Now all those businesses have too much leverage, and the price of that leverage has ballooned out. And so most of my sponsor clients are sitting back thinking, okay, how do I extend my option? How do I negotiate with my creditors on, keeping this business alive for everybody's benefit? And, where should I deploy my capital, in existing investments or in new investments, and kind of let the old ones go? And so my day is spent, as my daughter once said, serving as financial therapist, with, bright guys in the sponsor community who are trying to figure out how do we deal with these, pesky creditors who want to get paid back.
So when I think of restructuring, if I didn't know a lot about it, I'd think like really big public companies that are in some secular decline or the technology shift has taken over them. Is it, how has it evolved in the 23 years that you've been, or 20 plus years you've been in the business? Has it and kind of the big public company that got in trouble versus the sponsor, the middle market sponsor owned company and everything in between? Has that evolved in terms of the type of business? And is it always related to, like, we're headed towards a bankruptcy?
I would tell you that probably 70% of what we would call a restructuring gets done out of bankruptcy. Bankruptcy is expensive, it's time consuming, it's publicly disruptive, and we try and avoid it really whenever we can. And it's almost always used now when you have some subset of the stakeholders who won't agree to something that everybody else has agreed to. And you basically run to the judge and say, Your Honor, we've all come up with a commercial solution, but we have this minority group of people who won't do it. We need you to run over them. And assuming you have the votes in hand, that's usually what happens. And unfortunately, restructuring in the public view is bankruptcy. But what restructuring is in the professional perspective is, fixing balance sheets so that borrowers can, in fact, do what they do best, which is produce goods and services that people want to buy at a fair price and, return capital to investors. I probably
How is it not just like, well, here's what the document says, like, you trip this, it's over, hand me the keys. Like, it sounds like you're the broker in between the parties trying to figure it out, or you're hired by one of the parties to go get what they want done, or, like, sounds like it's highly negotiated after things have already been negotiated years prior when somebody came in with debt or equity or something, right? How does it all of a sudden get to be a big jump ball again to renegotiate everything?
You're basically taking a balance sheet that everybody agreed on on the front end. This makes sense under this set of circumstances. And then the circumstances turn out to be different. I mean, I can't tell you how many forecasts I've seen from management teams, and I can promise you every single one of them, the minute they were put on paper, they were wrong. Sometimes they're wrong high, sometimes they're wrong low. Most of the time when I get involved, they're wrong low.
Yeah.
And so you sit down with the current owner of the business, whether it's a public company board or a private equity sponsor or even a family, and say, okay, here's what you committed to. Here's what we can actually do based on the current performance of the business and what the business's trajectory looks like. And so we need to go engage with the other stakeholders, the creditors, about the current set of circumstances. And the reason why I sometimes get called a financial therapist is because you sit down with the creditor and say, I know you thought you were getting paid back in 6 months' time. Unfortunately, we're not going to be in a position to do that. And so they go through, the grieving process. First, there's anger. Then there's
you told
denial.
me last time we talked, you're a grief counselor. So
exactly.
So what does that mean? Like, walk us through the stages.
So first there's anger, and
there's I spend a lot of time in that stage. It's the most fun.
And then there's denial. No, you really can, I promise. And then there's acceptance. And the more times a creditor has been through this process, the faster that process runs, because they realize, okay, I can scream and yell, but is it really going to accomplish anything? Unfortunately, it doesn't.
And how often do you get your team hired by the creditor to sort it out, or versus hired by the equity? Or maybe I don't even have that right. Is it like the lender of the equity is hiring you?
So as a firm, about half our business is done on behalf of creditors, and about half our business is done on behalf of borrowers. Within the 270 some odd people that we have doing this on a day-to-day basis, there are those of us who kind of specialize in working with creditors, and some of us specialize in working with owners. And they can be public companies or private equity sponsors or families. And the reason why we've done that is because you have a better ability to anticipate what the needs of the owner are going to be, or the needs of the creditor are going to be. Although we do routinely have folks work the other side of the street so that you have a better sense of what your adversary is going to say or do. And it makes us, I think, better when it comes to providing advice to people that we do work both sides of the street. The firm was originally founded representing unsecured bondholders,
Yep.
and then as capital started moving away from traditional banks to private market lenders, we started doing more and more on behalf of private market lenders, and then the sponsor community saw us on the other side of the table and said, "Hey, what? You guys actually know what you're doing. I bet you'd be really good at helping us, push back on these creditors that are making all these demands on us." And so we developed a business on behalf of borrowers and sponsors out of that.
And are you getting hired by a borrower way ahead of time to help them avoid it, or then prepare for it, or is it like, hey, we got 24 hours, Tuck, can you please help? So I imagine you're getting hired by the creditor when things have already hit the fan and they need working out. That's maybe an assumption, a wrong assumption. And then on the equity side, I'd want to bring you in 9 months before I was going to hit that brick wall and help me figure out how to avoid it.
I wish every one of your private equity listeners would, in fact, adopt that mentality. I can't tell you the number of times where you get a call on a Friday afternoon. "Hey, I got your name from my lawyer, and he says you're really good at this restructuring business. We're not going to make payroll next week. What can you do to help us?" And at that point,
can you get to San Diego tomorrow morning, Saturday? We'll meet at the diner and figure this out.
Because we can't make payroll.
Yeah.
Whereas, as I would tell you though, most sponsors that we work for are forward thinking. They're looking at their portfolio company performances. They're looking at their balance sheets and they're saying, we might need to get some advice as to how to anticipate a problem. It's because it's always better to address it early than late. And so we will get calls from sponsors, a year in advance, because they see the direction that the performance is going. Oftentimes they'll bring in operational consultants to try and help them fine tune the engine. But when those guys run out of gas, to overplay the metaphor, they'll bring somebody like me in to say, "Look,
they've already called Alvarez and Marsal to come in."
Yeah, we've run all the juice we can out of this thing, and now we know what it can actually do, and consequently, we still need some help. And so we'll get involved and help them understand: are there new money solutions that might be available, or do we really just have to sit down with the stakeholders around the table and figure out a solution?
How does your team? And how's your team structured? Because again, a lot of people from the industry are probably thinking like, "Oh yeah, there's a Tux, the managing partner, there's a partner, there's a principal, a VP, an associate." They're thinking that potentially, given that you work at Houlihan. But how is your team structured? Because you got to fly in somewhere, figure it out pretty fast at a forensic level, and then decide maybe not. So do you have those capabilities on your team, industry expertise that would figure it out? Or you're like, these all kind of, it's either red, yellow, green. I kind of know how this works, and we go. I just got to call the creditor, and we start working it out. But how do you get up to speed on the state of the situation when I totally agree everybody thinks they're going to thread the needle, and then they can't thread the needle, and then it's I can't make payroll tomorrow. So the question is, what does your team look like for you to be able to get up to speed very quickly, assess the situation, and then what does your day look like as the guy who's kind of the senior guy in the team?
So for starters, because we have 270 odd folks that do this every day, we actually track somewhere close to 500 credits ourselves. Frankly, because we're looking for opportunities. We're in the fee generating business, and so our job is to call up people and say, "Hey, Mr. Creditor, have you been following Lumen, which happens to be in the paper today?" And we started tracking that one a year ago.
Yep.
Because we kind of saw the writing on the wall relative to the telecommunications space that they were in, and looked at their cash flows and looked at their debt obligations and their CapEx requirements. And we're like, there's a problem here.
Is that the old level 3 Lumen?
It is, yeah.
Amazing. Amazing how it's still around.
It was CenturyTel, then it was CenturyLink, and then they bought level 3, and now they call themselves Lumen. Anyhow, that's kind of the poster child for a situation where we got involved. Like I said, about a year ago, we reached out to the company, and they had previously engaged somebody, and so we started corralling various parts of their cap stack to explain to them why we thought there was a problem. It didn't take us much convincing to convince them that there was a problem. And then we reached out to the company on their behalf and said, hey, we'd like to provide you with a solution, because it doesn't do anybody at the table any good for this thing to hit the wall at 95 miles an hour. Nor does it do anybody any good other than the lawyers to file this thing for bankruptcy and spend a bunch of time, money, and effort in a Chapter 11. So that's kind of a poster child for why we are typically on the front foot on most situations. Now, there are situations where you've got a private equity owner and all of the debt is private, and that it's not publicly traded, or you can't get quotes on it, and there's very little in the way of information on it. Private, so what we call those. Those, we use our sponsor relationships and our industry contacts to say, hey, we see you're in the auto aftermarket business. How's that strike going to affect your business? And we've done enough auto aftermarket deals or supplier deals that we kind of know, all right, a 500-day strike and these people are all fucked. Oh, can I say that on your podcast?
Yeah, you can say anything on this podcast.
Okay.
People said way worse.
And so, we'll know to call. We'll say, hey, look, you don't have to be a genius to know that if there's a auto strike for more than a certain number of days, everybody's going to suffer. Or in the commodity space, the price of oil and gas drops 30%. I know who to call. They're all going to have a problem.
Yep.
In terms of how we staff things, again, it depends upon the complexity of the balance sheet. So I'll have a team of, 2 or 3 folks behind me who help me analyze the numbers. We'll actually interface with our corporate finance brethren who do healthy M&A and healthy capital markets work, because they may have an industry expert on a particular segment of some industry that we might not have or might not have run across. And so we'll use their industry knowledge as part of that team. And then, as I mentioned earlier, sometimes the solution is a piece of new money from somebody not around the table. So let's say, for example, you've got creditors who like the business and are prepared to give the business some more time. You've got a sponsor for reasons unique to their fund dynamics that can't put any more money in or can't put enough money in. You can find a piece of capital to kind of slot into. It's north of the sponsor and south of the debt. It tends to be pretty expensive, but you know what? If it helps get something done that helps the business kind of get through the process, then we'll use our cap markets guys to help find a solution that might actually involve new money. Typically, new money investors are pretty skeptical when they come to a situation where the creditors are at the table and the sponsors are at the table. New money tends to look around and go, why am I being given this opportunity? Why isn't somebody at the table doing this? But there are instances where,
hey, at the right price, at the right structure, like I'm open to suggestions. Let me hear it.
And a lot of what's transpired over the 20 plus years I've been doing this is that the nature of the investor has changed. So, the concept of a CLO when I first started, nobody knew what the hell that was. You had banks and bondholders.
Yep.
Now you had, banks less and less, certainly after the GFC. You had, direct lenders and private credit hedge funds. And then somebody invented the CLO out of the financial crisis. But those guys have limited flexibility on what they can and can't do. So oftentimes you'll go into a situation, you'll look at the list of creditors, say, oh, it's pretty CLO heavy. You can get those guys to agree to some accommodations that allow them to keep a performing piece of paper, slot something below them that's cheaper than the equity that the sponsor has, and kind of facilitate a resolution that way.
Yeah. So like mediator, grief counselor, therapist, galvanizer, like, hey, we need to make a decision, guys. Like we can't play around here anymore. Can we use the GFC and your experience during that a little bit? Talk about what happened, looking back on it, my big thoughts from the GFC would be, yeah, you know what? people generally behaved because you're either alive or dead. In 2008, this time 2008 heading to 2009, I think the clarity was, am I alive or am I dead? And there wasn't a lot of in between, and people behave. So you think of like TXU and some of these big buyouts. Obviously, WAMU gets washed out. TPG loses all their money. There's some big Toys R Us. There's some big
Lehman,
deals.
Bear,
Right. So you hear those, but then you hear the ones that like
AIG.
private equity is going to get smoked here because they put all this leverage on these deals. And a lot of those deals, if you played them out 5 years later, like they weren't great deals, but they weren't zeros for everybody.
Well, a lot of the distressed investors that I run across who are looking for, broken toys, if you will, it made a ton of money because they had capital and they stepped up and said, this is not a buggy whip business. It's going to have a reason to be. The people that own it now can't deal with the financial chaos. I'm going to buy it for a song and let the chaos pass. And then when the chaos passes, I'll sell it for a fair price and I'll make, 5x my money.
So is there anything we learned in the GFC? One, maybe what did it feel like for you? You're a decade into your career, GFC. And I mean, I would say like 2002, 3, 4, people think like, oh, it was 99, 2000 really sucked. I was like, I don't know. 2001, 2002, 2003, 2004 weren't that great. It was great 5, 6, 7. Then it got really nasty. So it wasn't like you stepped into like this amazing opportunity. Like it was choppy there for that first decade of your career. So what did you learn? What did you experience? And what were the lessons coming out of that?
Well, my first market disruption, because I spent the first 2.5 years of my career at Houlihan liquidating Enron. And if you remember, when Enron went down, everybody lost confidence in anything that had the word energy in it. They didn't care if it was oil and gas or power or what. It was like, I'm not touching it. And so we had a ton of energy related businesses that we restructured. And then you're right, we got to take a bit of a breath. And then along comes the GFC. One of my partners, Brad Gear, spent 5 years of his life, dealing with Lehman. I mean, talk about unwinding unbelievable morass of every financial instrument you can imagine. In fact, he's now our crypto guy because he's like, if you can understand Lehman, you can understand crypto. Anyhow, the GFC though was so much panic and so little confidence that we were going to survive that you didn't have a bid for a lot of things. And what the proper functioning of the financial markets needs is somebody's got to say, I'm going to be the bull here and I'm going to buy it because I think it does have a reason to be, even when everybody around me is freaking out. And it was that period of time when the proper distressed investor, the Apollo and the Oak Trees of the world, that's when they made the bulk of their money, in that cycle, is stepping in where no one else had the confidence to do it. Then you have the free money that follows that because everybody wants the economy to recover and everybody's going to be okay, and we want people to own homes again, and no political chaos. And then of course along comes COVID, sends everybody to their houses. Now we're afraid of dying as opposed to just being broke. And so again, you have people who are, some who are just completely freaking out. Anybody who owned an airline stock that, oh my God, nobody's ever going to get on a plane again. Zoom is going to, eliminate all business travel. We don't need office space anymore. And you had that same kind of, holy cow, the knife is going to fall forever. And you had some investors who stepped up and said, no, the knife's going to stop falling at some point. I don't know whether it's a year or 2 years or 3, but at some point it's going to hit the ground and we'll gradually go up from there. And then the slope of that curve is where people really debate, when does the curve start and what's the slope of the curve up? But at that point, unlike the GFC, enough people had decided and had convinced LPs to invest in distressed funds or distressed for control funds, that there was a lot of money waiting to pounce. And
Oh, because
so
they thought in 16 for sure this can't go on. Then they thought in 18 for sure this can't go on, and then they raised capital and kind of sat on it for a while because there was nowhere to put it. And then all of a sudden, boom, they got a lot of places to put it.
well, except that COVID, from a pure distressed investor perspective, COVID lasted a minute.
Yeah.
I mean, asset values plunged and then they went right back up once everybody realized we weren't going to all die.
Yeah.
And now what we're dealing with, as I said a few minutes ago, is the over levered balance sheets really across the entire economy, that exist because when people had, or when borrowers had difficulty because their top line was crushed. Okay, fine. I have a certain quantum of fixed expenses which I have to pay. I'm being encouraged by the government not to lay everybody off, thanks to TARP and the other programs that the government put in place. So they went and borrowed money, and money was free again. So why not? And no one bothered to hedge it. Not a single borrower I've dealt with in the last 2 years hedged anything. It was like they thought money was going to be free forever. I asked somebody, very intelligent investor, I said, what, Goldman Sachs and Morgan Stanley stopped selling interest rate hedges? What happened to those guys?
Yeah.
It used to be, back in the day.
They're too busy doing IPO, making all this money on IPOs and private equity and venture. Why mess around with these pesky little interest rate hedges? Yeah.
Yeah.
So is it? I mean, I would connect dots and say company balance sheets, post GFC, healthier than pre GFC. So I would say they're under levered. Companies performing pretty well, debt quite low. They go into COVID. Top line gets smoked. A friend of mine owned a linen rental and laundry business, and they had one market, Las Vegas. And their underwriting was like, Las Vegas has never had less than 80% occupancy rate in the history of Las Vegas, and so we'll underwrite it at 70% occupancy, and it went to 2% occupancy, right?
Yeah, 5, yeah.
For 6 months or a year or whatever. So they were like, okay, Las Vegas isn't. If we all survive, which we all figured out, we're going to survive, most of us, and people go back to Las Vegas. So they're generally weren't over levered. Certainly, as their revenue came in, they were, but then they're able to borrow at very compelling values that still had them be like
zero rate.
On a pro forma. Hey, when this gets healthy, you'll be highly levered, but not over levered. Coming out of this, if we normalize this, so everybody got comfortable around that, and then it got messy because nobody hedged. Is that safe to say? Healthy going into it, so they were able to get this leverage during COVID, and then it's biting them in the butts.
I mean, what everybody borrowed as much as they could to survive the business disruption that COVID created, and they borrowed it essentially. LIBOR, or now SOFR, was zero, thanks to the Fed. And okay, who cares if I pay a 400 or 500 point margin on that? I'm borrowing money at 5%. Who cares?
Yeah.
Now you double that. So SOFR is what, 5.5 today, I think.
Yep.
So you still have that 5-point margin on it. So now my money went from 5% to 10.5%. Well, that's eating at the cash flow of the business pretty meaningfully. And then when you layer in inflation, which has been eating at various parts of the cost structure of all these businesses, at the same time, it's kind of a double whammy. And, as I've said many times, the hardest inflation to get rid of is wage inflation. The only way you can get rid of wage inflation is fire people. And, and so, you've got to, that takes a long time to wring out of your cost structure. You have to make sure that you're not cutting bone, you're just cutting fat, and then people debate what that means. And so, as we look at a lot of these borrowers, they're struggling with, okay, I brought in my operational consultant. They've helped me figure out, where to cut and where to trim. I still can't afford my balance sheet because the Fed has, raised rates to 5.5%. And then when you layer on to the fact that all this debt is starting to come due 24, 20, I mean, right now we're dealing with 25 maturities.
So explain that, because I'm in the software world. They generally are lightly levered as an
Un-
industry, less
yeah.
than industrial or consumer. So there's a lot of recurring revenue debt out there that my guess is going to be tricky to unwind in the next couple of years. But everybody's kind of been waiting for the shoe to drop, waiting for the shoe. So you have insight into this, like what tranche of maturities are the ones that are going to start to hurt? Because we've heard people say like, well, we're not quite there yet, but man, Q1, Q2 next year, it starts to get rough. Like, how do you know that? What does that mean? Like, what data you look at to have a sense of the timing when things get tougher?
So we look at maturity dates and leverage levels of everybody that we can get information on, and and then we look at, okay, the market rate today for a reasonably levered business is 9-10%. You look at what their balance sheet costs them today, you look at the maturity date, you kind of say, all right, well, the interest burden is going to double. They're not going to be able to afford it. And they got 2 years between now and maturity. So they're not going to be able to refinance this problem. That means they've got to do something else. And that something else can be everything from approaching existing creditors and trying to get an amend and extend done, kind of a light touch restructuring, trying to sell the business and hope that somebody else out there, values it at north of the debt, and thus the private equity sponsor gets a return of recovery of capital, maybe actually a return on their investment, but more likely a recovery of capital. Or alternatively, you approach the creditors and say, hey, we can't afford our balance sheet. Let's figure something out that works for the company. And maybe I'll write a check, maybe I won't, and kind of approach it proactively like that, because it's
and you think of like 24, 25 because people were they had a 5 year bullet payment, and they took it out in 2020. So you're thinking 2024, 2025, 2026 is when things really start to get nasty.
a lot of what we did in 2020 and 21 was kick the can down the road deals for sponsors because of the consequences of COVID. So you went to the investor, to the creditors, and said, all right, we all know this is going to end at some point. The business is going to recover at some point, but we don't know how long it's going to take. You need to give us more time, because you, Mr. Creditor, don't want to take a permanent capital impairment and restructure this thing today at the trough. And it was a trough that was of nobody's making. It was lightning bolt from the sky. And so without many exceptions, the creditors all said fine. And you would get a year, 2 years, 3 years, depends on the business and depending on people's attitudes about the recovery. And so now those are starting to come due. If you had a 22 maturity in 2020, I tried to get you 2 or 3 years worth of an extension as part of that amend and extend discussion. Well, now it's 24 and 25.
Okay. So I assume you're busy.
Yes.
And do you anticipate getting busier? Maybe that's a different way to answer the question. Are you anticipating your team getting busier?
We do,
okay.
as a firm view, because I think we don't think that there's interest rate relief in the near term, certainly, and maybe even not the medium term, if the Fed sticks to their guns on wringing inflation out of the system, because it's a lot of this inflation is very sticky, and if they're serious, they're going to have to bring some pain to the economy to get it under control, and that means not lowering rates.
Yeah, and the jobs reports and the wage reports aren't helping. If, to your point, that wage inflation's the stickiest and the hardest to wring out of the system, right? I think the Fed would have thought, hey, I go from 0 to 5.5 in a little over a year. The layoffs are coming. We got that head fake on tech layoffs in Q1, where Amazon and at least for the big companies, the big tech companies were laying off 5, 10, 20,000 people at a pop. And then you look at it and you're like, they're just getting back to like 2021 levels of people. Like they're just getting rid of the 10, 20,000 people they've hired in the last 12 months. Like this isn't getting them back to something kind of more normalized. So there was a bit of a head fake on the layoffs.
And look at what the UAW just extracted from the automakers. I mean, those are inflationary wage concessions that they were able to wring out of the auto companies. And if you're the Fed, you're sitting back going, "Shit, I can't get this under control." Now, I'm not here to suggest that the auto workers don't deserve a raise. I know very little about the specifics of that situation, but what I do know is that if they're serious about wringing inflation out of the economy, then they've got a long time to go. And so, as we sit and think about this, we look at all these balance sheets that have been extended, 25 and beyond, they're going to have to deal with refinancing risk. Now, that's not to say that there aren't other solutions.
Yeah.
Like I said earlier, there are people who will invest capital and delever pure creditors, and they happen to be 14-15% return investors versus 20-25% equity investors. So there are ways to attack the problem other than just a full-on restructuring.
Yeah, I mean, and to my friends who are like rooting for interest rates to come down, I remind them like that only starts to happen when the economy is in really bad shape. So you're rooting for a really nasty recession before the Fed's going to say, okay, now we can start bringing these things down. And then down to what, right? I mean, the people who think the IPO window is opening back up and we're going back to 1 or 2% interest rates anytime soon. I'm in the Tuck Hardie camp of like, no, sorry, like I'm too old and I've seen enough of this to know like the fever dream was that was the outlier. The decade we just had, that was the outlier. That's not normal. And I'm sure you talked to your parents' first mortgage was probably somewhere in the low teens. My parents was probably in the high teens. It was about in the high teens. My first mortgage was 7% in the late 90s. Like that wasn't so bad. And on a reasonable post MBA salary, like we had a nice condo in Charlestown. It wasn't the end of the world.
I'm old enough to be able to say that my first mortgage was in New Orleans, Louisiana, and it was 11%.
Yeah, and look at you. And now you're a big shot at Houlihan Lokey. It all worked out just fine.
But the point of the anecdote is that you're absolutely right. The last 10, 12, 13 years that we've had, this easing of monetary policy is gone for the foreseeable future, absent some other COVID-like, catastrophic event that will change people's perspectives. The other thing that I was going to say is that we do look at industries and disruption of industries, because there are certain situations where whether it's ESG or technology or things like that, where things fall out of favor and investors just aren't willing to, regardless of the price, to get involved. And then the other thing we look at is, you stratify an industry segment. I'm looking for the people at the bottom quartile. I want to make sure that, we're taking care of those businesses because they might have a better home somewhere else. And that better home might be a better way for the sponsor to invest as part of a kind of a distressed merger, if you will. We do a fair amount of that. And then, there are sadly situations where the business just goes away, like a Bed Bath & Beyond or Toys R Us or Barney's or things like that. I mean, the brand name still exists, but the brick and mortar retail is gone.
Yeah, like, you're thinking, how do payphone companies survive, in 2003, 2004, right? That's not a bad place to hunt. And then I think imagine AI as a potential existential threat for certain types of businesses, maybe overhyped in certain areas, but probably underhyped in others, where things can get highly automated or offshored and highly automated to kind of change.
Somebody relatively recently said, "You're going to get automated out of business." I'm like, okay, but that's my kid's problem, not mine.
Yeah. And what was your major in college?
Economics.
Yeah. Okay. Yeah. Mine was art history. So I was like, okay, these people who sent their kids to go become coders, right? Because they'll always have a job as a coder. It's like, maybe not so much. Maybe you should have sent them to accounting school or become art history majors or econ majors.
How about diesel mechanic? Or I guess Elon Musk is going to put all those people out of business because we're all going to be driving electric cars.
But apparently not, based on the most recent quarter, right? To your point on the UAW, like, I was raised in a union household. I get it. Totally support the workers' rights, ability to negotiate. But, they just got a ton of concessions at a time when EV was the threat. And it's like, well, maybe not so much. Well, maybe the EV is doesn't have quite the staying power as we thought, and they just got some concessions at a time when the fortunes may turn around or maybe turning the other direction for some of the auto guys after not being able to keep cars on the lot. That maybe changed a little bit, but
Yeah.
anyway, let's talk a little bit about kind of like new innovations and hangovers and other things that are kind of floating around. So we talked last time we had a conversation about like private debt, very different than it was before. Unintended consequences of the GFC that are like, oh, okay, well, we made that policy change and now we're, while the money was free, not so hard, maybe now this is something we have to figure out.
Yeah. I mean,
And NAV loans, all these things are in there. So as all this new technology in the financial system has come up in the last 10 years, how do you think about it?
it,
How do you operate around it, and what makes it easier, harder, more complexity is probably good for you, but like, what are all these things that you're thinking about and coming up, having to deal with?
So you're right. The GFC had the effect of, the Congress, imposing a ton of new regulations on regulated financial institutions, which had the effect of driving capital away from them and into the private markets. So that the quantum of capital that's sitting in private lending vehicles is probably 7 or 10 times what it was before the GFC. And those folks have become incredibly creative at stratifying even themselves. So you've got CLO vehicles that are only allowed to invest in certain kinds of debt, and that guides their behavior when circumstances change, and it requires some form of restructuring or liability management. It's kind of the other buzz phrase you might hear. Then you've got direct lenders, BDCs, and then there's this trend towards asset aggregation in the private market, so that you have KKR now has a huge credit fund. Apollo has a huge credit fund. Apollo has an insurance company which they can use to fund deals now with even cheaper capital and make even more money. So what it's done to my business and what it's done to the sponsors that I work for is they have lots of choices as to where to go to get capital. But what sometimes they don't fully appreciate when they take that capital is those people are going to react differently than when things change. Circumstances are different than what was anticipated. And you've got to know broadly, all right, I'm dealing with a brown bear or a black bear or a polar bear. And each one of those is going to react differently when I come to talk to them about, what do I need to do given that the circumstances are different than what we all assumed when I borrowed this money.
Because in my first deal out of business school in 2000 was a portfolio company turnaround with, minus 10 of EBITDA, 90 of pref, and 110 of debt. And it was all the brand name banks, as you'd expect. Probably Comerica was in there too, because they were pretty big telecom and other lender back then. And then you knew how they were going to behave, right? They hired PwC for the workout group. The PwC guy, Chris, I still remember his name, came in every month, screamed at me, and we figured it out. And it was like, okay, I get what you have to do. And Comvest, is that who I'm thinking of? No, it's not Comerica. Anyway, I'm blanking on a lender's name. So, but you knew kind of how they behave. Now you've got 1,000 private debt lenders. Some, like I would imagine, the very large guys, hyper sophisticated. They've got the playbook. They know what to do and work out. But I would imagine none of these guys have ever seen workout before.
Certainly not in the quantum that they're going to have to deal with over the next 2 to 3 years. And unfortunately, for a lot of them, there's a slug of investors who are professionals that work inside these big asset aggregators who've never been through a downturn. As I said, my first one was the energy crisis that Enron created, then the GFC, then COVID. So, I've kind of know how this should play out. And you said, 20 minutes ago, does each one of these kind of have the same flavor to them? I mean, yes, in the sense that, there's always over enthusiastic business plans. There's always mergers that you don't get the synergies out of. there's the good old fashioned frauds every now and then. And then there are commodity shocks. So those are kind of and then there are, technology changes, disruption to a business or an industry. Those are probably the 4 or 5 things that we see most often. And then how they play out for a particular borrower is very specific to that particular situation. And then you've got to sit back and think, okay, who are my lenders? Well, do I have a regulated bank as my revolver lender? And I'm not going to name names, but they tend to be box checkers. They're regulated. They've got to report to a credit committee, and the credit committee's got to report to a regulator. So as long as I'm checking the boxes, we can keep going. The minute you say, sorry, I can't check that box, alarm bells go off. Then you've got, the private lending community, and each one of those guys have different personalities and different risk tolerances and different reactions. And if you've done enough of this and you kind of run across them enough, you kind of, okay, this is how Silver Point's going to react, or this is how KKR is going to react, or this is how Oak Tree is going to react. And then you have to worry about, oh, wait, what pocket of capital inside of Bain is this? Is this a Bain private equity investment, or is this a Bain credit investment, or is it a Bain opportunity fund investment? Each one of those guys will react differently as well. And so you have to know your audience, know how they're going to respond.
And which tranche has which rights, send me all the credit agreements. You may be a small player, but you came in last and you got, outsized influence or control somehow,
Yep. That's exactly.
Other people may want to behave, but one of them doesn't, makes it a lot harder.
So, well, and you raise an excellent point there, and that is trading. You could wake up on Friday morning and say, oh, I know who all these creditors are. I know how they're going to behave. And I kind of have a game plan in mind of how to deal with them. And then Monday morning when you wake up, you're like, oh, shit. It's all now been bought by SVP or some other rapacious, loan-to-own guy. Victor Kozla, who runs that place, will be very proud of the fact that I called him rapacious. He'll be like, oh, yeah.
Yeah, we've dealt with some of those guys. And we had this conversation before. I think we'll do another one of these podcasts, I think, because this will get a really good it's timely, and we don't often talk about the tough stuff. We're usually talking about the fun stuff. Are these private lenders ready to take the keys? At one, 2 is they likely share the same LP, given how much the voracious appetite on the private equity LP side. I think items 1, 2, and 3 on their Christmas list is private debt, private debt, private debt. I don't need more equity. I've got plenty of it, and unfunded liability, unfunded commitments there. Give me more private debt. And then private lender is staring at private equity owned asset and thinking like, okay, I share an LP, Goldman Sachs is in my private debt fund and an LP to this very large private equity firm that I'm about to take the keys of. Good for them on this side of the investment. And it may be in separate funds and separate pools of capital. Bad for the equity side of it. It feels like you get hired to then kind of negotiate this whole thing and basically like, all right, how do we make this work for everybody? Or do the private debt guys say, don't care, Goldman, you're in the equity and the debt, and this is just how America works, and there's a process for this, and Tuck tells us how it's going to go.
The asset manager doesn't care about the fact that there are common LPs, because the asset manager only cares about his tranche, because that's how he gets compensated. And so consequently, you will find a situation where a sponsor has taken money from some big sovereign wealth fund, and the sovereign wealth fund is also invested in the credit fund. But the guy who's running the credit fund and the guy who's running the sovereign wealth fund, the private equity shop, they don't care about the fact that it's the same sovereign wealth fund, because their personal compensation is determined based on their success or failure in negotiating versus the other guy. And so, at some point, the LP's got to go, whoa, boys, hold on here.
Yeah, can't we all just get along here and figure this out? And I'm sure Tuck and his team will come up with a great reason for us to just, plug our ears and kind of let this ball bounce for a little longer.
Or what will happen is the sovereign wealth fund will figure out what's going on, and they'll step up and say, you know what? I'm going to write another check,
I'm
going to write it through the credit side and take control of this business. And I'll just add the capital that I invested on the private equity side to my basis, and own the asset that way. And so they've got more capital deployed in the same situation, but they end up owning the whole thing. And it's just the other stakeholders that end up losing out.
Yeah.
I've actually seen that in a situation where it wasn't a sovereign wealth fund; it happened to be a family office. Stepped up and said, "Whoa, wait, this is crazy. I own that and I own this. I'm going to solve this for my own benefit. The rest of you people, the chips are going to fall where they're going to fall." Because they did see what was happening and stepped in. But that's the exception, not the rule.
Yeah. Incentives are an amazing thing to drive the right kind of behavior. So before I hit record, I told you this was going to fly by, and we're already coming up on time a little bit here. But I want to talk. I love to talk about NAV loans. I imagine that's a great place to go hunting for potential distress, but not today. We'll do another one of these. I do want to cover a couple things in like a bit of a lightning round because I think you'd have unique insights into this. Is the type of CEO that you've interacted with that can manage through a restructuring? Because oftentimes, there's the marathon runner and the sprinter. There's the growth person and the grind person. Are there traits in a CEO management team? They have certain things, or they do certain things that you've seen that gets them to the other side of it, or do you always have to swap out the guy before or the gal before for the new person who can run that play?
You don't want to swap them out if you can avoid it, because they probably understand the business reasonably well. And ultimately, that's what's going to drive the answer is, what's this business capable of under an agreed upon set of circumstances, kind of 80% confidence level. So you try not to. There are people who can't handle it, and you do have to replace them. I would say by and large, though, you don't end up doing that. One of my best outcomes is where the sponsor saw ahead of time, ooh, I need a wartime consigliere, not a peacetime guy. They went and brought the guy in 9-12 months ahead of time. He took a shit ton of cost out of the system. And he then looked at me and goes, okay, I've got this top running as fast as I can, as well as I can. How much of this debt do you think I can afford? He had a view. I had a view.
Yeah. Fix my balance sheet for me and let's go cut a deal. Yeah.
Let's go fix the balance sheet. I've now fixed the engine.
And how much of these are bad business versus bad balance sheet?
Right now, other than kind of the bottom quartile that's getting eaten by inflation, it's mostly bad balance sheets, right? You double the cost of the interest burden, and guess what? The math doesn't work anymore. Nobody handed out during COVID. Nobody said, all right, here's my business plan for recovering from COVID. Here's the slope of the curve coming out of the bottom. And oh, by the way, I'm anticipating a 500 basis point increase in rates. Nobody said that. Everybody's like, they just worried about how fast the consumer was going to come back to, the cruise ship or the airline or the movie theater. One of my partners and I did a movie theater deal during COVID, and it was like, all right, well, when do we think people are actually going to go back to movie theaters? And the sponsor said, I think they're going to come back on this date, generally speaking, or this time frame, and wrote a check and backed it up. It turns out he was wildly too conservative. Consumers came rushing back. Another deal that I actually did this deal on behalf of some creditors, was Cirque du Soleil. You mentioned Vegas earlier.
Yeah.
Most of Cirque's business was in Vegas, and the creditors, basically, the old sponsor tried to scare them into thinking that, oh my God, Vegas is dead forever, and you guys should take 20 cents on the dollar. And the creditors are like, wait, Vegas is dead forever? I don't think so. And so they said, no, we'll own the business. Kind of back to your point about our creditors ready to own the business. These creditors took this company over. They will make gobs of money because Vegas has come back roaring.
Big time.
And Cirque is doing better than it did pre-COVID.
I had a friend who just was telling me about the Cirque show they just saw, and it was a packed house and was an amazing show. It's so
the average ticket price and the attendance are higher than pre-COVID. It's amazing.
We could have another whole thing about is revenge travel over or not. So soon after GFC, I happened to be lucky enough to get invited to a dinner where the CEO of Alvarez Marsal was talking. And at one point he had been the CEO of Lehman, Enron, WorldCom, and maybe one other. And somebody
so Steve Cooper was a CEO of Enron, and it wasn't him.
Yeah, he basically had been like put in charge at various stages for to wind these businesses down. And
Yeah.
somebody said like, "What's the common theme?" And he said they're all and these were fraud and rampant mismanagement, over optimism, and other things, bad cultures. And he said one thing: rotten from the top. Businesses that wind up in that stage are rotten from the top. There's something going on. And that just seeps into the water of the business, and people wind up taking risks they shouldn't be taking because they saw their boss take it. It's kind of like the normalization of deviance, right? Like, well, how did Volkswagen, Audi, get in, Porsche get in this horrible mess? Well, it wasn't one big decision. It was just thousands of decisions to then, start to scam the emissions data. Like that happened over a decade or two. So that was kind of his thing, like kind of starts from the top and it just seeps into the organization. People just start doing bad things and eventually catches up to you. In your 2 decades in this space, are there kind of common things that people do to get themselves in this position that they need your help, right? Most people, there'd be a perfect world, nobody would need your help because they all make perfect decisions and manage it. Are there common pitfalls, and are there common things to avoid that you would say, do this, don't do that?
I think the most frequent problem is over optimism. People talk about glass half empty, glass half full. In my business, there's no glass, right? So I think the private equity sponsor community is inherently more positive than the credit community. And as a consequence, they tend to find themselves over-promising and under-delivering. Now, that's not always the case. Sometimes it's, in fact, exactly the opposite. Then there are things, like I said earlier, there's the integration of a merger that doesn't go well, and you don't get the synergy you thought, but you borrowed the money banking on the synergies, or they take too long. And then, somebody makes a competitive mistake. They build a factory in the wrong place, or they put out blue phones instead of titanium phones, and the consumer rejects it. Things like that. I don't know that I've ever run across. I've had, there's a debate as to whether Enron was a fraud, but I've only had a couple of fraud cases, and those were pretty blatant, and you kind of knew, all right, this was a crook. He wired the money to himself and lied to the accountants. So I don't know that I would say, rotten from the top is what I've seen a lot of, frankly.
All right. So hedge your interest rates. That's one lesson.
Well, not
Tuck
now.
Hardie.
Not
now. Yeah, not now. But when interest rate is when they're too low, and they're obviously maybe they weren't too low. When they're very low, you should hedge. And don't eat it all at the all you can eat buffet. Leave some for the guy behind you. All right. So if people want to get in touch with you, it's whardie@hl.com, and that's HARDIE. They can find you on LinkedIn, I'm sure, and all those things. I really enjoyed this. This was fun, and I have a sense we're going to check in with you from time to time and see how things are going. So
happy to do it. Happy to do it.
Thanks so much here.
From the heart of Chicago to all over the globe, a couple private equity geniuses, they share what they know. They love to mess with technology where the future is sink or swim. It's the Private Equity Funcast with Devin and Jim. Technology issues and middle market PE-backed companies, they bicker with each other and they don't take themselves too seriously. It's not venture capital, it's private equity. It's the Private Equity Funcast. Pour yourself a drink and have a seat. It's the Private Equity Funcast. That equity is private. If PE excites you, let it show and do not hide it. Devin and Jim.